This is your Lead Left podcast for the week of May 27th. I'm Randy Schwimmer. Welcome back. A longtime friend and keen observer of capital markets for almost half a century tells us when a rising Dow hits 10,000 increments, investors feel good, even though optimism may not be justified. And so we find ourselves mid-second quarter of 2024 with the Dow having reached 40,000, a destination that was Shangri-La not long ago. Like that mythical city somewhere in the Tibetan mountains, no one expected to find it in the real world. Yet barely 4 years from the COVID low of 19,173, here we are. What does this mean for investors? As KBRA's Van Hesser points out in a recent podcast, it's one of several bullish indicators. The U.S. economy is motoring along with expected 2.4% GDP growth this year. A Goldilocks not too warm that's keeping things going without reigniting inflation. Unemployment is on an unprecedented streak of below 4%. But consumer sentiment is stubbornly bearish. Housing costs and mortgage rates remain elevated. Food and energy prices are challenging for middle and working class budgets. And certain industries, such as healthcare, are falling behind growthier tech and software sectors. As we've discussed in previous weeks, the capital markets are similarly mixed. The broadly syndicated market awoke in January with fresh CLO dollars and retail fund cash to put to work. Yet while global M&A is showing more life than the past 2 years, many sellers remain on the sidelines. Of the $400 billion of institutional activity year to date, only about 10% of that is buyout related. Refinancings in the BSL market are targeting upper middle market loans held by direct lenders. The effect has been both to improve the financing structures of those borrowers and to create some spread compression across private credit. Nevertheless, the traditional middle market companies between 20 and 75 million of EBITDA retains much of its benefits for investors. Regardless of a record level of repricings, borrowing costs do remain high. The average all-in yield for first lien loans, according to KBRA DLD, is still over 11%. That theoretically limits the leverage private equity firms can impose on portfolio companies. Nevertheless, some credit managers in more desperate bids to deploy dry powder are offering aggressive terms to smaller businesses. Large cap features such as PIK-toggle and cov-lite provide cushions in balance sheets when pro forma interest or fixed charge coverage ratios sink below 1:1. But what does it tell you when the company can't pay its projected interest right out of the box? Over the next several weeks, we'll revisit private credit market trends for both issuers and investors in the context of where rates and the economy look likely to be headed. Reporting right out of the box here at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.